Welcome back to Investing Talk podcast. Today we're zeroing in on a company many of you are watching closely, Workday. Their upcoming earnings report is, well, it's a pivotal moment. And we're here to cut through some of the noise, really pull out the most important insights from analyst reports, historical data, market signals, the works. Our goal is to make sure you walk away truly informed about what's potentially on the horizon for Workday. So for this discussion, we're focusing specifically on Workday's upcoming Q2 2026 earnings to watch. We'll unpack everything from what Wall Street expects, how the stock has historically reacted, and what the market seems to be pricing in right now. Before we jump in, if you find these discussions valuable, please think about subscribing, maybe liking this, leaving a comment. Your support, honestly, it helps us a ton. And hey, if there's a specific company you'd like us to look into next time, definitely leave a comment below. We genuinely love hearing from you. You can also buy us a coffee if you appreciate our work. The link's usually down below.
Yeah, absolutely. We've really dug into a range of reports to try and bring you the crucial details for Workday. Our mission here is to give you a clear, concise picture, helping you feel, truly informed as they head into this next report.
Okay, great. So to really set the stage for Workday's earnings, let's start with the absolute basics. When are they reporting, and what are the Wall Street pros actually predicting for this quarter?
All right, so Workday is set to report its Q2 2026 earnings after the market closes on Thursday, August 21st, 2025. Definitely a key date to mark down if you're tracking the stock. Now, for the consensus expectations, Wall Street analysts are projecting revenue around $2.24 billion.
$2.24 billion, okay.
Yeah, and what's significant about that number is it indicates continued double-digit year-over-year growth, which, for a company Workday's size in the enterprise software space, that's still a very strong signal of ongoing momentum.
Right. And what about the bottom line, their earnings per share, the EPS? What are the projections looking like there?
So the consensus EPS estimate is sitting at $2.09 for Q2 2026. And if Workday manages to hit that figure, it would represent a pretty substantial 19.43% increase year over year.
Wow, nearly 20%.
Yeah, that's a significant jump in profitability if they pull it off. Could reflect, operational efficiencies kicking in, or maybe a better mix of higher margin subscription revenue.
We often hear about a whisper number around earnings, that sort of unofficial expectation, sometimes a bit higher than the official consensus. Is there anything like that floating around for Workday right now?
That's a good question. As of, August 14th, 2025, there isn't really a widely reported whisper number for Workday. However, it's worth remembering, for companies like Workday, which historically, they do tend to beat the official estimates.
Right, we'll get into that.
Exactly. The unofficial whisper is often just a little bit above that consensus. So while we don't have a specific figure, that general tendency is maybe something to keep in the back of your mind.
Gotcha. And what about the company itself? What guidance has Workday's management actually given us in their previous calls? Any clues there?
Yeah, so in their last earnings call, management guided for, and I quote, continued strong subscription revenue growth in the mid-teens and steady margin expansion.
Mid-teens growth, steady margins. Okay.
And what's really important here is that there hasn't been any noted material downgrade to that outlook since then, which suggests the company itself remains pretty confident in those projections. They haven't signaled anything, in their business or the broader environment that would make them pull back on those expectations. That in itself can be seen as a positive signal.
Okay, makes sense. Now, past performance isn't always predictive, we know that, but it certainly offers vital clues, right? So, let's open Workday's report card. How have they actually done in recent quarters, especially against those analyst estimates? Have they been surprising us?
They really have. Workday has a remarkably strong track record of exceeding both EPS and revenue estimates. And this isn't just like a statistical fluke. It often points to a management team that either guides conservatively or consistently finds ways to over-deliver, maybe signals a very resilient business model, or even underestimated market penetration.
So consistent beats then?
Very consistent. In fact, they've beaten estimates in the last 4 quarters straight. For example, Q1 2026. They significantly beat with EPS at $2.23 versus a $2.01 consensus. Revenue also came in higher. Going back Q4 2025, EPS were $1.13 versus $1.08 consensus, Q3 2025. EPS $1.08 versus a $1.03. And even Q2 2025, they beat with EPS at $1 versus 97 consensus.
Wow, that's a really solid streak. 4 for 4.
Yeah, it's a very consistent pattern.
Okay, that's impressive. But what really fascinates me, and I think our listeners too, is that a beat doesn't always mean the stock price pops immediately and stays there. Why do you think Workday, despite this consistent outperformance, sometimes sees such, varied reactions after earnings?
You've absolutely hit on a crucial point there. It's not always straightforward, which can be, quite counterintuitive for investors. The post-earnings price reaction for Workday has definitely varied significantly.
Hmm.
So after that Q1 2026 beat we just mentioned, the stock gapped up about 4%, and that move was largely sustained. Pretty good.
Okay.
But then Q4 2025, we saw an initial gap up, but then a reversal. The stock actually ended flat, despite a good beat.
Flat, even after beating, huh?
Yeah. And similarly, Q3 2025 saw a modest rally, maybe 2%, but it faded within just 2 sessions. And here's where it gets particularly interesting. Q2 2025, the stock actually gapped down.
Down after a beat.
Down. Because of guidance concerns, even though they beat on the actual earnings number for that quarter, it did recover after a couple of days, but that initial reaction, it highlights a really critical insight for these high-growth SaaS companies like Workday, which for investors, future projections often outweigh past performance. It really suggests the market is, well, less interested in what Workday did last quarter and far more focused on what they expect to do next and how that stacks up against their, frankly, premium valuation.
Right, right. It's all about the forward look. So, okay, a beat isn't necessarily a golden ticket for the stock price. What about the underlying trends then? Beneath those headline numbers, what's really telling the story of Workday's health?
Absolutely crucial. And if we connect this back to their business model, we've seen consistent subscription revenue growth in the mid-teens percentage range,
Okay, mid-teens subscription growth.
which is vital because for a software as a service, a SaaS company like Workday, that subscription revenue is highly valued. It signifies predictable, recurring income. It's basically the lifeblood of their business. Beyond that, margins have been gradually expanding. Their operating margin crossed 25% last quarter, which is a very healthy sign of increasing profitability as they scale up.
25% up margin. Nice.
Yeah. Operating income also shows a steady upward trend, indicating their core operations are becoming more efficient. And finally, they've consistently highlighted significant large enterprise customer wins.
The big clients.
Exactly, which speaks to their market penetration, the stickiness of their products, and their ability to land those big fish, securing long-term revenue streams. These are strong underlying signals.
Okay, that makes sense. Now, looking beyond the raw numbers and the history, what significant news or maybe broader developments have been at play during this quarter that might influence Workday's upcoming performance? Any big announcements, partnerships, that sort of thing?
Yeah, during the quarter, Workday made some strategic moves. They announced integrations with several major third-party cloud platforms,
Okay.
which are designed to enhance their enterprise solutions, basically making them work better with the systems clients already have, more interoperability.
Right.
They also expanded partnerships with global tech consulting firms.
Ah, the implementers.
Right. That's key because these firms are often the ones actually putting Workday solutions into place for those large clients. So it reinforces Workday's global reach and their implementation capabilities.
Got it. And on the flip side, any negative developments, anything that could be a concern, any red flags pop up during this period that investors should maybe be aware of?
No, importantly, there have been no material downgrades from analysts, no significant negative headlines, no executive turnover reported during this period.
Really? A clean slate.
Pretty much, which is generally a positive signal heading into an earnings report. A quiet news quarter often just means business as usual, and for a consistent performer like Workday, that's often good news.
Okay. So how does the wider sector, the macroeconomic environment, look for a company like Workday, operating heavily in enterprise cloud software, human capital management? Is the wind at their back or more in their face right now?
Generally, the broader environment looks quite favorable, actually. We're seeing strong demand for enterprise cloud software just across the board. Digital transformation continues to be a huge trend for businesses of all sizes.
Still a major theme.
Definitely. Companies are constantly looking to modernize their HR, their finance systems, and Workday sits right at the heart of that. Furthermore, interest rates have stabilized somewhat, which generally supports the valuation multiples for these high-growth SaaS stocks like Workday. Future earnings streams get discounted less aggressively by investors in that environment.
Right. Valuation support from rates.
Exactly. And if we look at their peers, companies in human capital management, HCM, and enterprise resource planning, ERP Workday's core areas, folks like Oracle and SAP, have reported pretty strong growth recently. That suggests there are sector-wide tailwinds that could very well benefit Workday in this report.
Interesting. So the peers are doing well too. What about the analysts, those watchful eyes of the market? What have they been saying lately about Workday? Are they leaning bullish, bearish, somewhere in between?
Well, Following Workday's last quarter's beat, several analysts actually raised their price targets. That's usually a vote of confidence.
Okay.
The consensus target for the stock rose by about 5 to 10% overall. The majority of analysts currently rate Workday as a buy or overweight, signaling a generally positive outlook.
So mostly positive signals from the analysts.
Mostly positive, yeah. However, there is a minority who remain neutral. Typically, they cite valuation concerns. It suggests that while they acknowledge Workday's strong fundamentals, they might see the stock as perhaps fairly priced or maybe even a bit stretched at its current levels, which could limit the upside potential from here.
So good company, maybe just expensive for some.
That seems to be the main caveat for the neutral camp, yeah. It's a balanced view, but certainly leaning positive overall.
Okay. Let's shift gears a bit.
Yeah.
Beyond the fundamentals and the broader market, what are the immediate technical signals telling us? And crucially, what's the options market often seen as a predictor of short-term moves saying about investor sentiment right now?
Yeah, looking at the chart, the stock has been showing some strength in the immediate run-up to earnings. It's advanced approximately 4% in the week leading up to the report, actually outperforming its sector during that time.
Outperforming. Interesting.
Yeah. We've also observed what looks like notable accumulation in both options contracts and the common shares themselves. That suggests increased interest, maybe some positive anticipation ahead of the report. This isn't just random noise. It can indicate that institutional money is positioning itself.
Right. And the options specifically, what are they implying?
What's fascinating here is that the options market, through what's called implied volatility, is pricing in a potential move of approximately plus or minus 7%.
7%. Either way.
Either way, exactly. For this earnings event, this isn't just a guess. It's the market's collective expectation, baked right into the price of those options contracts, of how much the stock price might swing after the announcement. We've also seen elevated call volume compared to puts.
Calls being bets on the price going up.
Right, which typically suggests a more bullish sentiment among options traders, at least directionally. But the options skew, which compares the price of downside protection puts versus upside participation calls, isn't extreme. That means there isn't an overwhelming fear or greed priced in, not suggesting unusual risk or expectation of a massive move one way or the other beyond that typical plus or minus 7%.
Okay, so the market expects a decent move, maybe around 7%, leaning slightly bullish based on call volume, but not extreme panic or euphoria priced in.
That's a good summary, yeah. Consistent with its historical volatility around earnings.
Got it. So, given all this information, the strong fundamentals, the mixed past reactions, the sector tailwinds, the options data, what are the main scenarios we could see play out after Workday actually reports? Let's paint a picture of a best case and maybe the worst case.
Okay, so the most bullish case, what people often call a beat and raise scenario.
The holy grail of earnings.
Exactly. That would involve Workday reporting EPS and revenue materially ahead of estimates, maybe by a wider margin than even their usual historical beats. And critically, we'd also need to see that subscription revenue growth and their margin expansion outpacing consensus expectations. In that scenario, management would likely raise their full-year guidance, maybe highlighting accelerating enterprise deals or strong traction with new products, or those platform integrations we talked about.
So beat the numbers and tell us the future looks even brighter.
Precisely. That would send a very clear, positive message to the market.
Okay. And on the flip side, what triggers a bearish reaction? What would cause the stock to pull back, maybe significantly, despite their strong track record?
The bearish case would obviously be a miss scenario if either revenue or EPS fall short of expectations, which, given their history, would be a pretty big surprise for the market.
Shock, yeah.
Yeah. We'd also look closely for any signs of margin contraction, the opposite of expansion, or a noticeable slowdown in key segments, especially that enterprise cloud adoption, which, as we discussed, is their core growth engine, and maybe, most importantly, a guidance cut. Or even just management sounding overly cautious about macro headwinds like a potential economic slowdown or increased competition. That would definitely dampen the outlook.
Because it's that future view again.
Exactly. Future expectations are often much more impactful on the stock price than past performance alone, especially for a growth name like this.
So with all these different metrics, growth rates, guidance, market signals, what's the single most important thing for our listeners to really watch when Workday reports? If you had to pick just one metric, the one that truly defines the outcome, what would it be?
That's a really important question. What's the absolute key metric to watch here? For Workday, I'd have to say it's the subscription revenue growth rate.
Subscription revenue growth. Okay, why that one specifically?
Because this particular metric, more than almost anything else, drives the valuation and the sentiment for a company like Workday. Much more than the headline EPS number, frankly. As a SaaS company, that subscription revenue indicates how many new clients they're acquiring, how many existing clients are expanding their usage, and the overall stickiness and predictability of their business model.
It's the core engine.
It's the core engine. If you're looking for one thing that really matters for the long-term health and investor perception of Workday, that's it. A strong subscription revenue growth number confirms their market position and their future earning potential.
Okay, crystal clear. Subscription revenue growth is the number to watch. So, based on everything we've discussed, history, market sentiment, technicals, the whole picture, what's your overall leaning for Workday's upcoming earnings? Bullish, bearish, neutral?
Taking it all together, our leaning is overall bullish.
Bullish, okay.
Yeah, we see that strong fundamental momentum carrying through, the consistent history of beats suggests a well-managed company that knows how to execute. You've got positive sector trends providing a nice tailwind, and even that bullish tilt in the options activity. All these factors seem to align to suggest a potentially favorable outcome, though, nothing is ever guaranteed in the market.
Right, always the caveat. How confident are you in that bullish outlook, say on a scale of 1 to 10? And what are the risks, the main caveats listeners should keep in mind, even with that positive leaning?
Okay, on a scale of 1 to 10, let's put our confidence score at a 7.
A solid 7.
Yeah.
Right.
The streak of beats and the improving fundamentals certainly support a positive surprise, and the market generally rewards that. However, that higher implied volatility we talked about, the market pricing in that plus or minus 7% swing, that means there's significant potential for downside, too, if expectations aren't met or guidance disappoints. That volatility cuts both ways. And just general macroeconomic uncertainties always warrant some caution. So it's a conviction, yes, but one definitely tempered by those market realities.
Understood. So for our listeners who might be considering a move around these earnings, what are some potential strategy considerations? Thinking about different risk tolerances, what approaches could someone take?
Okay, good question. For the more risk-averse investor, it might simply be wise to wait. Wait for the post-earnings clarity, see what happens. If the numbers come out solid, but the price sells off on that initial knee-jerk reaction, which we've seen happen with Workday before, that could actually present a buying opportunity after the dust settles and the market digests the news.
Patience can pay off.
It often can. Now, for the more risk-tolerant investor, strategies that aim to profit from that anticipated volatility could be on the table. For example, buying option structures that profit from a large move in either direction, like a straddle, could be considered. Or if you're directionally bullish, specifically betting on a move higher with call spreads might be viable to define your risk.
Taking advantage of the expected swing.
Exactly. Conversely, if you believe the market is overestimating the potential swing, maybe you think the stock will stay within a tighter range than that 7% implied move, then option selling strategies could be looked at. Things like an iron condor or a short strangle. These profit if the stock stays within a predefined range.
But higher risk there too, right?
Absolutely.
Right.
Option selling always requires very careful risk management because the potential for large unexpected moves is always there, even if it's built into the pricing. And of course, just holding the common shares through earnings carries risk, especially given the recent volatility in that implied move. But it might be justified if you have disciplined stop-loss measures in place to limit potential losses if things go the wrong way.
So know your risk tolerance, have a plan.
That's the key. Match your strategy to your risk tolerance and always apply careful risk management.
Great advice. So to bring it all together then, Workday heads into its Q2 2026 earnings with a really solid track record, some favorable market wins at its back, but also with the market clearly pricing in a significant potential move. It really highlights how even consistent performers can surprise us with their post-earnings volatility, often driven as much by future guidance as by past performance.
Yeah, and this raises, I think, an important question for you, our listener, to ponder. How much do you personally weigh a company's past performance versus the current market sentiment, the implied volatility, and those broader economic trends when you're making investment decisions, especially around an event like earnings? It's a really dynamic interplay, isn't it? And it really determines the outcome. It's a decision every investor has to make for themselves based on their own analysis and comfort level.
That's a great thought to chew on as Workday's earnings date gets closer. We really hope this breakdown has given you a clearer picture of what to watch for. Remember again to subscribe, like, and comment to support us. Let us know what companies you'd like us to look into next. We really appreciate you joining us. Thanks for listening, and we look forward to the next time.